Investing in the US can feel overwhelming, but don't worry, I am breaking it down into simple, actionable steps. Today in this video, we will cover the different investment options here in the US, how to set financial goals and match them with the right investments, how to open a brokerage account and start investing, and how to build a well-diversified portfolio, the tax consideration that can help you save money. So let's get started. Hi everyone, welcome back to my channel. If you are new here, I talk about finance, investing. So make sure to hit that subscribe button. My name is Parul and I'm an economist. Okay, understanding the US investment options. Well, there are many ways in the US to invest, each one with its own risk and return profile. So let's break them down. First, let's start with stocks or equities. So what is it? When you buy a stock, you essentially own a small portion of a company. So stocks are the foundation of most investment portfolios because they have the potential for high long-term returns. And how do you make money? Well, two ways. First is capital appreciation. This is when the stock prices go up and your investment increases in value when you sell it. And secondly, some companies will pay dividends as part of the profits to the shareholders. So if you had invested in $1,000 in Apple 10 years ago, it would be worth over $10,000 today. Now, what are the risks? Stocks can be volatile, meaning prices can fluctuate wildly. Short-term losses are very common, but historically, the US stock market has grown around 10% annually over the long term. And the long term is any period more than 8 years. Now, look at bonds. So what are they? Bond is like a loan. You owe the money to a government or a corporation in exchange for regular interest payments. So bonds are considered safer than stocks. And how do you make money on them? Well, interest payments or coupons. So the bond issuer pays you periodic interest. And capital gain, if you sell the bond for more than what you paid, you make a profit. US Treasury bonds are one of the safest investments and they're often used for capital preservation. In terms of risk, there are lower returns, which is 2 to 5%, and bonds can also lose value if the interest rates in general rise. Now, next is exchange traded funds or ETFs. So basically, ETFs are a collection of multiple stocks or bonds, all packaged into a single investment that trades like a stock. Why should you invest in an ETF? Well, first is diversification because it reduces your overall risk by investing in multiple companies. And they're low cost. ETFs usually have lower fees compared to mutual funds, and they're easy to trade because they're bought and sold like stocks. So for example, S&P 500 ETF like SPY or VOO tracks the 500 top companies of US because it's basically mimicking an index. Now, in terms of risk, ETF has similar risk profile as stocks or bonds or commodities depending on what it is holding. Next is mutual fund. Well, it's basically a professionally managed portfolio of stocks, bonds, or other assets. Unlike ETFs, mutual funds are actively managed, meaning the fund managers make buying and selling decisions for you. So, for example, Fidelity Growth Fund, FDGRX, is a popular mutual fund investing in high growth companies. And they have higher fees because they charge for their management. And usually it can range from 0.5 to 2%. So that will eat up part of your profit because you have to pay the fees. And they're also less flexible because they are not traded throughout the day like stocks or ETFs. So you can only buy it at the end of the day and sell it at the end of the day. What are index funds? Index funds are a type of ETFs or mutual fund that are passively managed. So basically they track index, as the name suggests. They have low fees and there's no active management. So it means overall lower cost. They are really good for long-term investing. I strongly recommend S&P 500 ETF and S&P 500 index fund from Vanguard. Well, in terms of risk, they basically follow the market. So if the market crashes, so does your investment. But it is unlikely that the top 500 companies in the US will fail. So it's a good strategy for long-term investment. So again, it depends on how soon you need your money. So if you have a short-term goal, for example, and you need the money in 1 to 3 years, then you stick to low-risk investments like bonds and high-yield savings account, and then avoid stocks because short-term volatility can lead to losses. There's no guarantee. And if you need money for a house down payment in the next 2 years, don't put that money in stocks. Okay, next we will look at the long-term goals, which are 5 years plus. Stocks and ETFs are best for building long-term wealth. You have time to recover from any type of short-term market downturns. So for example, if someone is saving for their college and they needed the money after 15 years, it's best to invest in S&P 500 index fund. This way, you can ride out any type of short-term market fluctuation and expect a good return of around 10% annually. Or you can also invest in a broad-based ETF like S&P 500 ETF. Now, how to buy and sell investments? So first step is to open a brokerage account. So to invest in the US, you will need a brokerage account. Okay. So what are the documents that you need for that? First, you need a social security number or an individual tax identification number for non-US citizens. You will need your address proof of the US and a linked bank account. Now, you need to also choose a broker. So they have options of full service brokers like personalized advice, but they charge higher fees. For example, Merrill Lynch, Morgan Stanley. And then we also have online brokers, which are low cost, easy to use platforms for DIY investors. Some examples are Fidelity, Schwab, Robinhood, and Vanguard. Now I want to tell you some fun fact. Robinhood introduced commission-free trading, which made investing more accessible to many people. Next step is to diversify your portfolio. Why is diversification important? Well, it spreads risks across multiple assets. So you reduce the impact of one bad investment, okay? So for example, if the US stock market crashes, having investments in another country like Indian stock market can help you stabilize your portfolio. Now let's look at asset allocation strategies. So this strategy uses your age, which means 100 minus your age should be the percentage of stocks in your portfolio. So if you are 40 years old, 100 minus 40, which is 60% of stock should be in our portfolio. As you grow older, this stock percentage will fall. And also risk matters. So conservative people can get more bonds compared to stocks. Next is the tax consideration for the US investors. Now, capital gain taxes happen when you make a profit by selling your investment. And if it's held for less than 1 year, you're charged a short-term capital gain tax rate, which is same as your regular income. Depending on your bracket, it could be 10 to 37%. But if you've held the investment for long term, which is more than 1 year, then you are charged maximum at 20%. And depending on your income, it could be either 0%, 15%, or as I said, max 20%. If you sell a stock after 6 months, you could pay a higher tax than if you were to hold it for more than a year. So pay attention to that. In this section of video, we will talk about some tax advantage accounts. They're mostly for retirement. The first is 401k, which is an employer-sponsored retirement account, which tax benefits. Second is traditional IRA. It's an individual retirement account, but you open it and it's not through your employer, but you have to look at the income limit and how much you can contribute. Similar to 401k, the taxes are deferred. Then we have something called Roth IRA, where you pay taxes up front, but your investment goes tax-free. So use a mix of investment to balance your risk and return and align your investments with your own financial goals. Use tax advantage accounts for smart investing and make sure to diversify across different asset classes and geographies. So if you haven't, open a brokerage account, research 2 to 3 ETFs that match your goals and calculate your risk tolerance. What's your biggest investing challenge? Let me know in a comment. I will be happy to read and answer any questions. If you found this helpful, please don't forget to hit the like button and subscribe to my channel. My name is Parul and I will see you guys in my next one. Take care.